Hi, this is Dan Kelly. Let's take a look at an installment note problem. So here we have ABC Company issuing a note to a bank and taking out an installment note versus a traditional note. As we know, installment notes require installment payments, so regular payments that include both interest and principal. In this particular case, the company has borrowed $25,000 with a 5% interest rate. They're going to do this on January 1st. They're going to pay it back on April 30th of the same year. So this is only a 4-month note, but the bank would like them to make installment payments. This is similar to a mortgage note or a car loan or something like that. These are the types of loans that banks use in those situations. So this will be applicable to maybe something you've done in your personal life as well as here in academics. So, okay, so the first thing we want to do is we want to be able to fill out a little chart here based kind of a loan schedule, if you will, okay, based on things that we're going to do. So on 1/1 of 18, there's no payment, no interest, any of that kind of stuff. We just have $25,000 that's been borrowed. That's how much we're going to pay out. So we can go about figuring out the payment one of two ways. We could use a loan calculator online. So if we go to mycalculators.com, they have a loan calculator, and we would just go main mortgage loan, okay, because that would have monthly payments. The loan amount is $25,000. The number of months is only 4. The interest rate is 5, and that's an annual interest rate. And it'll pump out a payment for us of $6,313.79, and then we can view the amortization schedule, and it looks like this. Okay, so we have our, well, I didn't change the dates, but you see the first month, the payment, what remains, how much went to principal, how much went to interest. The second month, the payment, how much went to principal, how much went to interest, etc. So that's one way to get this done. Another way to get this done is to actually make Excel do it for us. So in that case, we would type in a payment formula, which is PMT, and then I'll hit the little button up here to help me through this. So it wants to know what's your interest rate. That's 5%, but that's an annual rate, so we'll look at it on a monthly basis. What's the present value? What's the number of payments to be made? And that would be 4, January, February, March, and April. The present value of the loan is $25,000, and that's all it needs to know. And it comes up with a payment of $6,315, which is just slightly off the one that the loan calculator came up with. So we'll go ahead and make that a positive number to make it look a little nicer. Okay, and then the interest calculation is based on how much was being loaned out, okay, times the annual interest rate, and we'll divide it by 12. Okay, so that's $104, and the principal is simply, okay, you made a payment, 104 went to interest, how much goes to principal? 6211, excuse me, and then the remaining balance would be 18,789, which is taking the 25,000 less the 6211. So our payment won't change over time, so we can simply tell Excel to make it the same thing over and over. The interest calculation also won't change. It's still going to be what remains times 5% divided by 12. Okay, now I'm going to do a little Excel trick so that I can not have to write that formula every single time. And I'll show that to you. Okay. So we just copy this down, Control D. Oop. And copy this down, Control D. And we see that we end up at $0 at the end, which is what we're after, and a consistent payment. Now, to be clear, I will not ask you to calculate this on an exam. I will not make you fill this out. I will not make you calculate the payment, calculate the interest, etc. But I think it's a good thing to be able to at least see it be done. If it's something you'd like to have me help you develop further with like a car loan or a mortgage loan, you come see me and I'll be happy to help you with that. Okay, but now the question is, how do we record our journal entries? So the first day the loan is made, or the money is borrowed, we debit cash. and we credit notes payable. Okay. On 131 of 18, we're going to be reducing notes payable. We're going to be recording interest expense, and we're going to be crediting cash. Cash is in the amount of 6315. 6315. Okay. Notes payable is 6211. This is all based on our schedule, and interest expense is 104. So 104 to interest, 6211 to principal. That totals up 6315. Okay, and then we're going to make that same entry over and over and over again for the next couple months, except we're going to change the values. Okay, so the cash payment will remain the same, but what goes to principal versus what goes to interest will change. So in February, the principal payment was $62.37, and the interest payment was $78. In March, the principal payment was $62.63, the interest payment was $52, and in April, it was $62.89, and the interest payment was $26. Still coming up each time with a full payment of $63.15. Notice there is no need to go and debit notes payable and credit cash at the end because we've been doing that all along. So there's, unlike the traditional note, there's no final entry to kind of clean that up. So, the bank doesn't make a ton of money here. Total interest comes up to be $261, but maybe it's just a short-term loan that ABC needed to help them get them through a tough time or something like that. So again, I will not test you on making the schedule. So you can do that via the loan calculator, right? The amortization schedule that we talked about here, or you can learn how to do it in Excel. But what I will test you on, though, is the journal entries. How do we record journal entries based on this schedule? So the principal payment goes to notes payable, the interest goes to interest expense, the payment goes to cash, etc. So if you have questions on these, I'm happy to assist you. Please do reach out. And as always, I thank you for your time.